All right, let's dive right in. Today, we are pulling back the curtain on a really fascinating financial strategy that's happening in the real world, right now. We're going to see exactly how one investor is making a huge, high-conviction bet on a brand I'm sure you know, Lululemon.
So let me just ask you this. What if you could get paid right now in cash for just agreeing to maybe buy a stock you love at a massive discount later on? I know, it sounds almost too good to be true, right? But that is the exact idea behind the strategy we're breaking down today.
And the company we're putting under the microscope is the athletic apparel giant Lululemon. We're going to dissect a very specific trade which really gives us an inside look at how a professional investor thinks. This is all about understanding the logic, the why, behind their big money move.
Okay, so to set the scene, let's get the numbers straight. Right now, around mid-December 2025, Lululemon stock is trading for about $205 a share. Got it? 205. Just keep that number in your head for a minute.
Now, here is the most important number in this entire strategy. $160. This investor is basically betting that the stock will not fall below this price. Now think about that. That's a 22% drop from where it is today. That is a huge margin of safety.
And you know, this isn't some bet that plays out over years. Nope. This thing has a very specific and very short deadline. January 16th, 2026. That gives this whole scenario only about 30 days to play out. So what in the world is this strategy? Well, it's called selling a cash-secured put. But hey, don't let the jargon scare you. The absolute easiest way to think about this is that the investor is acting like an insurance company. They collect a cash payment up front, that's called a premium, and in exchange for that cash, they promise to buy Lululemon's stock at that lower price, at $160, but only if the stock actually drops that low by the deadline.
So you gotta be asking, why $160? Why that specific number? Well, it was definitely not picked out of a hat. It's the absolute core of this whole thesis, what we're gonna call the $160 fortress floor. It is a calculated line in the sand.
Now this right here tells a really powerful story about the company's value. At its current price, Lululemon is trading at about 14 times its earnings, which is already pretty cheap for them historically. But just look what happens at that 160 strike price. The valuation plummets to just 10 times earnings. For a top-tier brand like Lululemon, that is deep, deep value territory.
And this quote just perfectly sums up the investor's mindset. They're basically saying, look, I would be absolutely thrilled to own this incredible company at that cheap of a price. If the market is crazy enough to sell it to me down there, I will buy every single share I can get my hands on.
But a cheap valuation is really only half of the story of this fortress. Check out this number, $159.25. What is that? Well, that happens to be Lululemon's 52-week low, almost exactly where they set their price.
And that's the kicker. The investors set their 160 strike price right on top of what traders call a major technical support level. This is the exact spot on the chart where, in the past, buyers have jumped in and defended the stock from falling any further. So it's a fortress built on two things, a cheap valuation and historical price strength. Okay, so let's move to the second part of this thesis, and this is where things get really clever. It's all about turning the market's fear into a financial advantage.
So what's causing all this fear? Well, news just dropped that Lululemon CEO, Calvin McDonald, is leaving the company. Now, this kind of news always creates uncertainty, it makes investors nervous, and that nervousness is exactly what this investor is waiting for.
Because, you see, when the market gets nervous, the price of that insurance, that options premium we talked about, it gets way more expensive. You can see it right here. The premium you can collect when fear is high is way bigger than normal, so our investor isn't scared. They are literally selling that fear to others. They're getting paid extra to take on a risk they were already comfortable with anyway. So how does this trade actually pay off? Well, from this investor's point of view, it is structured as a win-win. Let's walk through the two ways this can end, because both are pretty good for them. Okay, scenario A. This is actually the most likely outcome. Lululemon stock just stays above $160. If that happens, the options expire worthless, and the investor simply keeps 100% of that cash premium they collected. Boom. Pure profit. A fantastic return for just 30 days of waiting. But what if the stock does fall? Well, that's scenario B. The investor now has to buy the shares, sure, but they get to buy them at that fire sale price of $160, the price they already decided was an incredible deal. So they win by getting to own a great company at a huge discount.
Now, obviously, no strategy is a sure thing. So a good analysis has to look at the fine print. We have to ask, what could actually go wrong with this seemingly perfect setup?
Well, there are three main risks here. First, a big market crash could just pull everything down with it, including Lululemon, maybe way below that 160 floor. Second, what if the CEO leaving is just the tip of the iceberg? What if there's some really bad news about the company that we don't know yet? And third, there's always the risk of a value trap, where something that looks cheap today just keeps getting cheaper tomorrow because the business itself is actually in trouble.
But when you step back and look at the whole picture, the verdict is pretty clear. This is a classic value investing strategy, really in the style of someone like Warren Buffett. It's all about patiently using the tools available to you to either make some income or to buy a fantastic company that you already love, but only at a price that makes you slam the table and say yes.
So that leaves us with the big question. Is this trade a brilliant masterclass in finding value and cashing in on fear, or is it just a dangerous, high-stakes gamble on trying to catch a falling knife? I guess we'll find out on January 16th. Thanks for joining me.